December 1st, 2025, the day the Fed officially terminated quantitative tightening. The balance sheet is now frozen at $6.57 trillion after draining $2.39 trillion from the system since mid-2022. Now, this is a significant policy shift. But what I want to do in this video is walk you through what actually happens. What happens now after QT ends? Because there's a sequence to how liquidity moves through the financial system, and understanding that sequence can help you make sense of what to expect in the months ahead for crypto. So let's just jump right into it. Now, let's first establish what just happened, what just occurred. Check this out from SVB Asset Management's analysis. Technically, the most recent balance sheet runoff, quantitative tightening 2, officially ends December 1st, 2025. This is the second time the Fed is ending a QT program in the past 10 years. It's notable that the FOMC minutes from October confirmed that nearly all policymakers agreed to end quantitative tightening on December 1st. This was actually earlier than many expected. The decision to stop QT came sooner than earlier expectations, including a New York Fed survey that had predicted the runoff would end in the first quarter of 2026. So we should pay attention to the fact that the Fed moved faster than anticipated. Now, before we get into the historical playbook, I want to go over something that I think is incredibly important to go over. Ray Dalio, he just recently put out a post called Stimulating into a Bubble. I definitely recommend you look into it if you have some time, but he's framing this Fed move as more significant than just a technical maneuver. And his perspective on what it means for risk assets is worth understanding. He notes that Chairman Powell said at a certain point, you'll want reserves to start gradually growing to keep up with the size of the banking system and the size of the economy. So we'll be adding reserves at a certain point. And Dalio's key insight is about the mechanics of what happens when the Fed buys bonds and creates liquidity. He writes, the Fed's increased QE should be expected to lower real interest rates and increase liquidity by compressing risk premia, pushing real yields down and pushing PE multiples up, and especially boosting valuations of long duration assets such as tech, AI growth. He goes on to say, it would be reasonable to expect that similar to late 1999 or 2010 to 2011, there would be a strong liquidity melt-up that will eventually become too risky and will have to be restrained. Now, what makes Dalio's framing particularly interesting is that he's pointing out this is happening in very different conditions than previous QE cycles. In the past, easing came when valuations were depressed and the economy was weak. Today, valuations are elevated, credit spreads are tight, and the economy is relatively strong. So if the Fed does move toward active balance sheet expansion, it would be, in his words, stimulus into a bubble rather than stimulus into a bust. For risk assets, including crypto, that's a setup worth paying attention to. Long duration assets and assets at the far end of the risk curve tend to benefit the most when real yields compress and liquidity expands. So with that context in mind, let's look at what happened the last time QT ended, because history still gives us a useful framework for sequencing. Now let's look at what we can learn from the last time that this happened. The last time the Fed ended a QT program was in 2019. And it's useful to study what happened then because there are some parallels today. The Fed started quantitative tightening in the fall of 2017. And by mid-September 2019, the Fed had drained $700 billion in reserves from the financial system. On September 16th, 2019, collectively, this resulted in a large outflow of liquidity and strains emerged in short-term funding markets. For example, the secured overnight financing rate traded 300 basis points above the federal funds rate, with some repo trades touching 9%. Now we're about to segue into what all this means for crypto, but this was a significant stress event that I did want to highlight. Secured overnight funding rate spiked 300 basis points in a single day, and the Fed had to intervene with emergency liquidity injections. The reason I'm bringing it up is because the good news is the Fed appears to have learned from that experience. Check this out from SVB's report. The Fed is clearly approaching this most recent quantitative tightening ending cautiously, and we don't anticipate a repeat of turmoil in short-term funding markets. The Fed has learned a valuable lesson. And also from 24 Asset Management, the Fed is trying to engineer a situation where reserves stop falling just before they become scarce. But this is more art than science, as there are several factors that influence demand for and the supply of liquidity. But here's the key observation from 2019 that's relevant for crypto. When QT ended in 2019, risk assets like crypto did not immediately rally. This is why I'm consistently saying it's not like December 2nd, we're going to pump. Bitcoin consolidated for several months. The altcoin bottom didn't come until December 2019, around 3 months after QT ended. Crypto analysts are noting this pattern. Check it out. The end of QT marked the bottom of the altcoin index against Bitcoin back in August 2019. So QT ending marked an inflection point, but the actual price appreciation came later. There was a lag, and understanding why that lag exists is important. That's the purpose of this video. I want us to understand the lag. So let me walk you through how liquidity typically moves through the system after QT ends. There are essentially 4 phases. Phase one is the drain stops. Let's think about this in terms of weeks 1 to 4. When quantitative tightening ends, the immediate effect is that liquidity stops being removed from the system. The Fed isn't draining anymore, but it's also not actively injecting. It's essentially neutral. Markets can stabilize, but they're not necessarily going to rally immediately just because the pressure stopped. And then we can look at phase 2, which would be system stabilization. We can think of this in terms of months, maybe 1 to 2 months. Over the next month or two, the financial system needs time to simply stabilize. Bank reserves stop declining. The reverse repo facility finishes its draining. It's already near zero. Treasury markets find their footing. This is the foundation being laid right now. It's not exciting, but it's necessary for what comes next. And then we have phase 3, which is credit rotation. Once the system stabilizes, you typically start to see credit spreads narrow and equities start picking up. Small caps and growth stocks tend to outperform during this window. This is when liquidity is actively rotating into riskier assets. Check out what Janus Henderson says in this analysis. Credit spreads have tightened due to strong supply-demand dynamics, better than expected economic data, and tariff relief. And also from CFA Institute's analysis on small caps. We're in the 12th year of a small cap lagging cycle, longer than average. Historical data suggests a reversal is near. Then we have phase 4. Crypto tends to be at the far end of the risk curve. It's typically one of the last asset classes to receive significant liquidity inflows during a rotation. Based on historical patterns, and we do not have a lot, this tends to occur maybe around 6 months after quantitative tightening ends. But we've only had one other quantitative tightening in US history, and we had COVID that happened shortly after quantitative tightening. So it's very difficult to put even a pattern on that. The point is the flows arrive later, but they tend to be more pronounced when they do arrive. So what we're looking at is a process that unfolds over a couple of quarters, not days or weeks. Now let me connect this to manufacturing data, one of my favorites, because this is where we can track the real economy's contribution to the cycle. Today's ISM manufacturing PMI was just released. From the official report, the manufacturing PMI registered 48.2% in November, a 0.5 percentage point decrease compared to the 48.7% recorded in October. Economic activity in the manufacturing sector contracted in November for the 9th consecutive month. So we're at 48.2, still in contraction territory. Remember, below 50 indicates contraction, above 50 indicates expansion. If you're a crypto bull, if you want to see the bulls step in for altcoins, we want to see PMI above 50. And here's why this matters for the thesis that I've been developing. Historically, PMI tends to bottom around the time QT ends and then begins to turn up as the real economy responds to improved liquidity conditions. When PMI moves into expansion, that's demand returning, credit creation accelerating, and that typically coincides with risk appetite really picking up across asset classes. Here's Susan Spence, chair of the ISM Manufacturing Business Survey Committee. Continuing a recent trend, a previous month's improvement in one index was evident in another gauge. After new orders strengthened in August, production improved in September. An improvement in the backlog of orders index in October transferred to the production index, which expanded in November. So there are some green shoots appearing in the data, even though the headline number is still contracting. The improvements are starting to flow through different components of the index. Now let's look at where the crypto market sits right now in terms of positioning. Bitcoin dominance is currently around 59%, down from about 61.4% a few weeks ago. From XC's analysis, Bitcoin dominance hit 59.03% in November 2025, down from 61.4% just weeks earlier. This 2.37 percentage point decline erased roughly $80 billion in Bitcoin's relative market weight. For traders who lived through 2017 and 2021, this number triggers muscle memory. Dominance peaking near 60% preceded the most explosive altcoin rallies in history. Now, to be clear, the altcoin season index is currently at 24, which means we're still in what would be classified as Bitcoin season. Capital is still favoring Bitcoin's relative safety and liquidity. Here's Crypto's RS as reported by CoinPaper. Alt season is not canceled, it's just delayed. Global liquidity has not supported a full rotation away from Bitcoin. Now, this aligns with the framework I've been discussing. Liquidity conditions haven't yet supported a full risk rotation, but with QT now ended, the conditions for that rotation can begin to develop. So let me summarize the framework. QT ending is essentially the stop signal. The drain is over and the system can begin to stabilize. PMI moving into expansion territory would be the go signal, the green light. That's when real demand is returning and credit conditions are actively improving. Crypto, being at the far end of the risk curve, tends to be one of the later beneficiaries of liquidity rotation. But historically, the moves have been significant when they arrive. Right now, we have the stop. QT ended. December 1st, 2025, it's over. PMI is at 48.2, still in contraction. We don't have the go yet. We don't have the green light yet. Bitcoin dominance is at around 59%, showing some early signs of softening, but still elevated. It could even tick up a little higher. If we apply the historical pattern from 2019, the stabilization phase would run through early 2026. Credit rotation would pick up through Q1 and into spring. And the more significant crypto flows would potentially arrive in the spring, summer, even into the fall of 2026 timeframe. Of course, every cycle has its own characteristics and there are no guarantees, but understanding this sequence can help provide context for what to watch and when to watch it. So that's the framework. QT has ended. The liquidity drain is over. Now we monitor the stabilization process, watch for PMI to turn, track credit spreads and small cap performance, and look for signals that liquidity is actually rotating into risk assets. And on top of all of those other things, let's monitor everything going on within the crypto space, the Clarity Act, market structure, everything happening from a pro-crypto legislation standpoint. Everything is really coming together if you're a macro value investor. There's no doubt this entire cycle has lagged. Everything has changed. Everyone has been thrown off. But one thing is for certain, if you just zoom out on the cycles, if you zoom out on liquidity and crypto charts, there is a strong possibility that we are still very early. As always, we have to monitor and balance our risks appropriately. I appreciate you watching. If you found any value from this content, please subscribe, hit that like button on the way out. And if you're not in our intelligence system, we have a free trial going on right now. If you are a macro investor and you're serious about making unemotional decisions, data-backed decisions, risk-based decisions, you can sign up for a free trial and start testing out our risk models. We have a bunch of assets back there. Would love you to join our members and give us a shot. I will see you all in the next video. God bless.